One day after the International Monetary Fund cut its forecast for global growth this year to just 3.3%, IMF head Christine Lagarde is trying to put the best spin on the austerity programs that many blame for the lack of growth. She says it could have been much worse.
The economic world no longer looks quite as dangerous as it did. At the same time, the pickup in financial conditions, financial markets, is clearly not translating into a sustained pickup in growth and jobs.
For Europe, Lagarde is still keen on an interest rate cut by the ECB, saying that can help struggling small and medium-sized companies and unleash much-needed credit for households to invest again. But this economist questions the whole IMF approach. He told us austerity has produced the same results it always does, that there's no growth, no return to growth. I don't see why the IMF's surprised. The IMF is well aware of this. It's imposed austerity on all countries where it's stepped in. The ECB could cut its interest rate a little bit, but it is virtually at zero. There's not much it can do. It's now up to the governments and the IMF. They can stop the austerity. It doesn't work. Indeed, after 3 years of crisis, austerity appears not to be working, nor is the money printing by central banks producing the long-looked-for economic recovery, and many fear it's actually paving the way for future crises.